Stock market. So what happens to the stock market then? If money is flowing into the stock market, what happens to the stock market? Yeah. So let's skip ahead a year now. The stock market moves, where is it? 1,120. A year later, we're at over 1,200. What happened to the yield curve? The middle money is about the same. The long end of the yield curve is about the same, but now what? What happened to the short term in just 1 year? Rates are going back to sort of normal levels, normalization, okay? Instead of borrowing money like now, it's practically free, or 1%. I think at that time when they lowered interest rates, they lowered it to 1%. But now something's happening. The economy has been rising probably for 4 or 5 years. The stock market's been rising, right? Let's say 2002, 2003. So 1, 2, 3. We're at the end of 3 years. We're going into our 4th year of a bull market rally. So does the Fed need to keep interest rates at 0? Nope. Because now they're worried about inflation, right? So the Fed's normalized the rates, and now look at it. It used to be 1% to borrow money for 3 months. Now it's 2%, guys. 2% to borrow money. So interest rates to borrow money overnight for short term have doubled. But can your business keep functioning if you have to borrow money at 2%? Can you still stay in business, or is it a deal breaker? Yeah. Because there's still potential for profits, right? Now, how does the stock market work? Why do stocks go up? Thank you. Prospect of the future is good. Well, let me say it differently. Prospect of future profits. The future might be good, you might be expanding, you might be hiring, you might have new products, but if you're selling everything at break even and there's no profit at the end, your stock doesn't go up. It's future profit. So for example, I bought Bank of America just before they started laying people off. My wife says, oh, well, that sounds bad. I'm like, no, it sounds good. Because that's already been priced in. 6 months to a year from now, after they've laid everybody off, they're going to report higher profits than this year, right? Because they're going to get the same amount of work done with less employees, so they're going to be more profitable than they were 6 months ago, 6 months from now. So they're going to say, well, compared to last year, profits are way up. And guess what? The stock market goes up and I make a ton of money. So it's future profits that entice people to invest. Okay, so again, at 2%, you could probably still make a profit. Right? Good. Therefore, even though the cost of borrowing money is doubled, there's still a high likelihood that a healthy business is still going to be profitable, and therefore the stock market will still continue to rise. Are you following the logic? A to B, B to C, C to D. So interest rates have doubled, but it don't matter. In fact, it's normal. But it does show that the Fed's no longer stimulating the economy. It's now a free-floating economy, and therefore healthy. So let's move ahead now in from the beginning of 2005 to the end of 2005. Holy schnecker schnocker. Now what the hell's going on, folks? 12 months goes by. We still haven't broken 1,300, So the stock market is moderately up, but you can see peak to valley has done very little. Very little. It opened there, okay, and closed here. So peak to peak, it's been a very little increase. So it's been just slightly better than a flat year in the stock market. But what happened? All right, what happened here? Yield way up. What happened here? We went from 2 years ago, we were paying 1% overnight money, or sorry, 3 months money. Then it went to 2%. Now it's almost 4%, guys. It doubled and then doubled again. Can you see how there's something significant going on in the economy? I mean, that's a doozy, right? Let me remind you where we started. So now it's 4%. Wow. Wow. So nobody is investing, nobody's lending these companies money now, right? So they have to pay a high price. So if you're going to borrow money for a year, you might as well borrow it for 10 years because there's almost no difference. You see that, guys? A 12-month loan is the same as a 7-year loan. There's no difference in cost. So you might say, well, that's good. Well, that's bad, though, if you only needed the money for a year. Well, how about this? If you needed the money for 3 months, you pay 3.74%. But if you need it for 7 years, you pay 3.94%. I mean, you're like, dude, that overnight is pretty significant. It's starting to cost some real money. What happens to your profits, guys? So this is when business owners start streamlining. You know what I mean? Trying to make the extra profit through a better supply chain. They start maybe buying larger inventories and getting a better price. And they're looking at efficiencies everywhere, from the factories that make their products to the shipping to the warehousing to the advertising. Maybe they lay off a couple of employees or something, but now they're struggling, right? Now they're struggling. They have to work hard for their money. It was easy when the money was free, but the downside to that was there was very little people out there buying.